What if I told you that most people don't lose money in investing because they're unlucky? They lose because they keep repeating the same stupid mistakes over and over again? You work hard, you save money, you finally decide to invest, and somehow your portfolio starts looking like a crime scene. One stock crashes, one coin disappears, one great opportunity turns into a life lesson. And the worst part? Most investors have no idea they're sabotaging themselves. So in this video, we're breaking down 10 mistakes that quietly destroy your investments. And if you recognize yourself in even 3 of them, that might explain exactly why your money isn't growing. Investing is supposed to be simple. Buy good assets, hold them long enough, let time do the heavy lifting. But that's not what most people do. Most people invest with emotion, panic, ego, impatience, and way too much confidence from watching 3 motivational finance videos at 2 a.m. They don't build wealth, they build regret. So let's talk about the 10 biggest reasons your investments keep failing and how to stop ruining your own future. 1. You invest without understanding what you're buying. This is one of the most common mistakes, and honestly, one of the dumbest. A lot of people buy things for one reason only. Someone online said it would go up. That's it. No research, no understanding, no clue how the business works. No idea what problem it solves, no idea how it makes money. Bro, this one is about to explode. What? Let's go! Investing like a billionaire! Internet! Buy everything! Moon soon! Billionaire, stop! Let me say this clearly. If you don't understand it, you shouldn't invest in it. Because the moment the price drops, you won't know whether to hold, buy more, or run away screaming. And most people do exactly that. They panic because they never had conviction in the first place. They didn't invest, they guessed. And guessing with money is just gambling in a nicer outfit. 2. You're chasing hype instead of value. This one ruins people fast. A stock goes viral. A crypto coin starts trending. Everyone on social media is posting rocket emojis like they personally discovered money. And suddenly your brain says, I'm not too late. This is just the beginning. No, usually, by the time everyone is talking about it, the easy money is already gone. You're not entering early. You're arriving at the party when the chairs are already on fire. Hype makes people blind. It creates urgency. It makes bad investments look exciting. And excitement is dangerous in investing. Because the more emotional the crowd becomes, the less rational your decision-making gets. Smart investors don't ask, what's going viral? They ask, what is this actually worth? Big difference. One question builds wealth. The other builds bag holders. This one is a silent killer. A lot of people enter investing with completely broken expectations. They think if they invest today, they should see life-changing results by next month. They want their portfolio to behave like a lottery ticket, not a long-term machine. And when that doesn't happen, they get bored. They get frustrated. They start making reckless decisions. They switch strategies every 2 weeks. They jump from stocks to crypto, from crypto to options, from options to whatever nonsense is trending next. Because deep down, they're not investing. They're chasing speed. And that's the problem. Real wealth is usually boring in the beginning. It grows quietly, slowly, almost invisibly. And most people quit before compounding has the chance to look impressive. They dig a hole, don't find gold in 5 minutes, then move to another hole. Then another, then another. Meanwhile, the patient investor who stayed in one place ends up finding the treasure. Fear, greed, panic, overconfidence. These 4 emotions have destroyed more portfolios than bad markets ever could. When prices go up, people feel invincible. They buy more, thinking they're geniuses. When prices crash, they feel sick. They sell, thinking everything is over. So basically, they buy high and sell low. The exact opposite of what they should do. Why? Because emotion hijacks logic. Investing is one of the few areas in life where doing what feels comfortable often gives you worse results. When everyone is euphoric, you need discipline. When everyone is terrified, you need calm. But if you don't control your emotions, the market will control you. And trust me, the market has no mercy for emotional people. A shocking number of people invest with no real plan. Ask them, Why did you buy this? When are you selling? How much risk are you taking? What's your goal? And the answer is basically, I don't know, I just felt like it. That is not a strategy. That is financial freestyle. A real investor has rules. They know what they buy, why they buy it, how long they plan to hold. How much of their money goes into one investment? What would make them sell? Without a strategy, every market move feels personal. Every dip becomes a disaster. Every headline becomes a threat. Every green candle convinces you to do something impulsive. A strategy protects you from yourself. And without one, you'll keep reacting instead of thinking. This is where overconfidence gets expensive. Some people find one stock, one coin, one company, one once-in-a-lifetime opportunity, and they throw half their money into it like they've unlocked the secrets of the universe. That's not confidence. That's concentration risk wearing a motivational quote. No matter how good something looks, no investment is guaranteed. Things change. Markets change. Leaders fail. Laws change. Narratives collapse. And if too much of your portfolio depends on one idea being right, one mistake can wipe out months or years of progress. Smart investors diversify not because they're scared, but because they're realistic. They understand a simple truth. You do not need to be perfect to win. You just need to survive your mistakes. And concentration makes survival much harder. Everybody loves upside. Nobody wants to think about downside. That's why bad investors ask, how much can I make? But smart investors ask, how much can I lose? That question changes everything. Before every investment, you should be thinking, what's the worst case scenario? Can I survive it? Am I comfortable with that outcome? Because if one bad trade, one crash, or one bad year can destroy you financially or mentally, then your position is too big, too risky, or too stupid. Harsh, but true. People love the fantasy of massive returns. They rarely prepare for massive pain. And investing without respecting risk is like driving fast with no brakes and saying, don't worry, I'm focused on the destination. So if your investments keep failing, it's probably not because success is impossible. It's probably because one of these habits is quietly sabotaging you. You buy what you don't understand. You chase hype. You expect fast money. You let emotions take control. You invest without a strategy. You take too much risk. The good news? Every one of these mistakes can be fixed. Because better investing is not about being a genius. It's about being less reckless, more patient, and much more honest with yourself. So before you go looking for a next big opportunity, maybe fix the habits that keep turning opportunities into losses. If you enjoyed this video, subscribe, because we're going to keep breaking down money, investing, and the psychology behind why most people stay broke, even when they think they're doing everything right.
Which of these 7 mistakes have you made before? Be honest. Your portfolio already knows the truth first.